Hey everyone, it's your friendly neighborhood commie bastard here, and it's time for an overview of the Federal Reserve System. The Federal Reserve System is the central bank of the United States of America, the country with the planet's largest economy, and the ancestral home to the hamburger, the firearm, and the Bible. The America's central bank is now in its third iteration, and its task is a twofold one: maintain stable levels of prices and maximize employment to achieve non-inflationary economic growth. And at the time of this recording, the Federal Reserve has actually accomplished just that. Prices have been rising stably, and the inflation rate is around 2%, maybe a little bit higher. The Federal Reserve has been hitting its target rates, and the unemployment rate is around 4%, sometimes even lower, which signifies maximum employment in the economy. I know the title of maximum employment might seem a little misleading, especially when media outlets proclaim that. But that's just kind of the nature of capitalism, I guess. You can't have 100%. Man, we're just teaching bourgeois economics out here, okay? Just stay with me and just consider it full employment. We're just gonna run with it. And more importantly, the growth period has actually been really good. We're actually in the second longest growth period in the history of the United States. This is a fact that President Trump has been touting all over Twitter, and for good reason. It's a pretty great achievement. However, most of this growth period has actually been under the Obama administration. President Trump hasn't been president for very much that long. It's been like a year and a half. So, I mean, I don't love Obama, but this is just facts. I'm just saying it as it is. However, not everyone is as happy as Donald. There's been plenty of critics that have been attacking the Federal Reserve in recent times, especially right after the financial crisis of 2007 to 2009. Famous economists such as John B. Taylor have criticized the Federal Reserve for keeping interest rates far too low, which partially caused the financial crisis because it caused the housing bubble. Other politicians such as Libertarian Senator Rand Paul and other Tea Party movement advocates have attacked the Federal Reserve System for devaluing the US dollar far too much. Some critics even go so far as to say that the Federal Reserve System is in conspiracy against the American people by collaborating with the so-called 1%, the ultra-wealthy, the ruling class, the bourgeoisie, at the expense of the average American, of course. So are these critiques valid? Is it true that the Federal Reserve is actually causing more harm than good in the market economy? No. The Federal Reserve System has actually been, in my opinion, a very respectable institution. Not just good, respectable. And that's kind of a rarity in this country. The Federal Reserve System is, I think, very much misunderstood. But before I refute some popular critiques against the Federal Reserve System, I think it's absolutely pivotal to understand what the Federal Reserve System actually does before we can criticize any of its actions, something most critics probably have not done. So, let's get right into it. As its name suggests, the Federal Reserve System is actually made up of multiple different components and not just one central bank. Well, more like just two components. First of which is the 12 regional banks. Each of the 12 regions of the United States has its own regional Federal Reserve Bank. And each of these are tasked with regulating and supervising the financial sector in their particular region. This mainly consists of making sure chartered banks fulfill their reserve requirements. This is absolutely pivotal because the whole point of the Federal Reserve in the beginning was to make sure that banks have enough liquidity to not cause bank runs that plagued the United States when there was no central bank authority. I'm looking at you, Andrew Jackson. You done goofed. Anyway, for example, let's say your bank is Citibank, and as this very, very simple T-chart shows, or a T account, whatever you want to call it, and on the right side, there are about 100 million deposits from savers, right? On the left side, there are the assets. Now notice that on the asset side, there are only $90 million in loans. That means that it's not able to loan out all the deposits from the savers to investors. About 10% of the liabilities are kept as reserves in the bank itself or in the regional Federal Reserve Bank. This is to make sure that there's enough liquidity in the bank if people want to take out a lot of money at once. So the Federal Reserve has to make sure and enforce that chartered banks fulfill this reserve requirement. The second task that they must fulfill is monetary policy, which we will get to very soon. Now, we're done with the regional banks. The second component of the Federal Reserve System is the Board of Governors. The Board of Governors consists of about 7 members with one chairman or chairwoman leading this little committee. And their task is to simply oversee the 12 regional banks, talk to the presidents of the 12 regional banks, and just get a feel for the economy and how it's doing. The second task is to also implement monetary policy. So, what the hell is this monetary policy? How does this create the non-inflationary growth that Congress mandated the Federal Reserve way back in 1913? How does they do it? Well, monetary policy, strangely, is not enacted entirely by the 12 regional banks or the Board of Governors. In fact, they come together to form a committee. The presidents of the 12 regional banks and the 7 members of the Board of Governors come together to form a committee known as the FOMC, or the Federal Open Market Operations Committee. When people talk about the Fed, when the media says, hey, the Fed are raising interest rates, what they really mean is the FOMC is committing to monetary policy. And what they do is do something known as Federal Open Market Operations. Now, it may seem a little complex, but it's gonna be not too difficult. So, bear with me here. Recall that regional chartered banks, right, have to adhere to reserve requirements. Around 10% of their liabilities has to be placed in reserves. You would think that this is quite easy, but banks go through millions upon millions of different transactions over the course of a single day, trading securities, accepting deposits, okay with withdrawals, etc. like that. So what they will have to do is maintain these reserve requirements at the end of the day, at the end of their banking activities. But they realize, oh, we didn't fulfill the reserve requirements. We do not want to get penalized by the regional banks. Let's fulfill the reserve requirements. So what they have to do is take extra reserves from, let's say, JP Morgan. JP Morgan has excess reserves. So Citibank is going to be like, hey, let me get some extra reserves so I fulfill my requirement. JP Morgan is a commercial bank, though. And nothing's for free. No money, no talk, right? So JP Morgan is going to charge interest for these excess reserves for Citibank. And the average of these interest rates, these short-term rates that banks charge each other for like overnight loans, is called the federal funds rate. This is extremely important. The federal funds rate is the average interest rate that banks charge each other for overnight loans in order to fulfill their reserve requirement ratios. Now, generally speaking, the lower the amount of reserves in the financial sector, in the banks, the greater the interest rates, because the demand is there if reserves are low and people are going to want to borrow more. And vice versa. If there are plenty of reserves in the chartered banks, then the federal funds rate won't be that high. It would be kind of low simply because the demand won't be there. Most banks, can fulfill their requirement. So there it is. Now you should be asking yourself, so what does this have to do with monetary policy? Well, the Federal Reserve really wants to control the federal funds rate. Controlling the federal funds rate controls the economy. But if the federal funds rate is determined by the banks themselves, how did the Federal Reserve change this interest rate? Well, they simply do so by changing the amount of reserves in the chartered banks. That's simply it. So how do you do that? What, they forcefully take reserves out of chartered banks or increase them? No, they do something known as Federal Open Market Operations, which is just a fancy term for buying and selling U.S. Treasury securities. Now, what the hell is a U.S. Treasury security? Well, it's a debt instrument that pays not only interest in the future, but eventually its principal, much like a bond will. And speaking of bonds, a very famous one is war bonds. When a state is preparing for war or still in war and it doesn't want to raise taxes but still want to raise funding for war, all it has to do is sell bonds because investors will be giving their money to the state, but then the state will eventually have to pay them back along with interest. So war bonds are always popping when there's a war going on. So the Federal Reserve buys and sells US Treasuries. And the regional banks, the chartered banks, have to buy or sell these. So what they're going to use to pay for these securities is their reserves. So there you have it. The Federal Reserve System buys and sells US Treasury securities to increase or decrease the amount of reserves in the chartered banks. So let's give an example. I know this is a little complicated, but let's give an example. Let's say the US Federal Reserve, right, wanted to increase the interest rates, increase the federal funds rate. Well, what they're going to do is start selling US Treasury securities to your local Citibank. Now, Citibank has to pay for them using their reserves. So their reserves are going to be much lower than they normally would be. Now, they have to go to JP Morgan for some excess reserves. Now, the whole system, though, has lower reserves because the Federal Reserve has started to sell US Treasury securities, so reserves are much lower, but demand now is a little bit higher. So there you have it. That's how the Federal Reserve controls the interest rates. All they have to do is lower or increase reserves, I guess artificially, you can call it that, by buying or selling US Treasury securities. Now, if you're still paying attention, what you should be asking yourself is, why go through all this trouble to change interest rates? Like, how does this control the economy and maximize employment? Like, what does this do? This is extremely pivotal, as this is the only type of monetary policy the Federal Reserve uses now. So let's get right into it. Let's say you're a car guy or a car girl and you really want an enthusiast car. Well, how about a Porsche 911 GT3 RS? Incredibly stiff chassis, naturally aspirated inline six, just beautiful German engineering. You want it so bad. You've already used all your retirement funds. You used up all the money in your son's like student college funding, all of that to buy this car. But it's still unbelievably expensive. And you can't afford it with just simply cash. So you need to finance it, or lease it, or take out some sort of loan for this automobile. Well, again, you're going to go to your local Citibank and ask for some loans for this car. However, what if the Federal Reserve decided to increase some interest rates here and decided to lower the reserves in Citibank, so Citibank has to borrow from JP Morgan. Now, Citibank has to pay for JP Morgan's excess reserves, or else they get penalized by their regional bank. So they have to pay for the interest rates charged by JP Morgan, the federal funds rate. And that interest rate is obviously going to be trickled down to you, because you're going to have to not only pay the interest rates for the car, but you're going to have to be paying the increased interest rates from the increased federal funds rate. You're starting to understand me here? Citibank is a commercial institution, and when their cost of doing business also goes up, their cost of their products, their loans to you, is also going to go up. Which is great for your kids, because maybe they'll finally be able to eat some regular home-cooked meals again, or be able to go to college. But you would be a little less happy because you couldn't afford your Porsche 911 GT3 RS. And that kind of sucks. And it sucks for the economy. The economy is doing well when everyone's employed and buying commodities. If people are buying Porsches, you know the economy is doing real good. So, the next question now should be, why does the Federal Reserve increase interest rates? Why don't they just keep interest rates extremely low? That means people can afford Porsches or afford a lot of things that people buy with loans. Like, I don't know, houses, cheaper cars, anything. Well, not so fast. The issue with people buying commodities is it may increase the probability for something known as inflation. unstable, high levels of price increases. So let's get right into it here. Let's say the economy is at full employment. The economy is doing real good. Everyone you know is working somewhere. I don't care if it's Chipotle or Goldman Sachs. Most people you know are employed in the economy, which is great because not everyone's buying things and exchanging commodities. However, like I said, it may cause an increase in inflation. So there's kind of a trade-off between maximum economic growth under maximum employment and high levels of unstable price increases, because the prices are going to increase if everyone can afford to pay for them. So the Federal Reserve noticed this trend and has to control for inflation. Another way to understand it is with a very simple mathematical econometric model named after the famous Keynesian economist Phillips. This is a very simple graphical representation of that econometric model called the Phillips curve. As you can see, the bottom is the unemployment rate or inflation. It flips sometimes. And on the y-axis, it's either the inflation rate or the employment rate, right? So there is a trade-off in the short run, in the span of 10 years. If the economy is in full employment and growth is maximized, you might get some inflation hikes. And Federal Reserve, if you remember, if you were paying attention, wants to maximize non-inflationary economic growth. So no, it's a terrible idea to lower interest rates all the time and keep them really low. You want to control for inflation. Yes, that might restrict growth. You might not be able to afford your Porsche 911 GT3 RS, but the economy won't be spiraling out of control with inflation running amok. So the Federal Reserve Bank has to do a really good job in pinpointing when to increase or lower interest rates. And it has to take into consideration the employment rate, are people buying commodities, etc. And when it does want to change the interest rates, all it has to do is lower or increase reserves. And it does that by buying or selling U.S. Treasury securities. So there you have it. That really is the Federal Reserve, man. That's really what they do. So what's the problem? Why do people hate the Federal Reserve? What's going on here? Let's tackle some of them one by one. The first one up is from economist John B. Taylor. And he says that the Federal Reserve has actually lowered interest rates far too low in the past, which caused the financial crisis of 2007 and 2009. Side note, if you didn't know what caused the financial crisis, I'm going to sum it up real quick here. Interest rates was pretty low, and the economy was running pretty hot. Everyone was working, everyone was employed. Well, most people. Again, this is capitalism. You can't have everyone employed, right? Sorry, Marx. Well, anyway, economy was doing good, but housing prices would keep going up. And that was good for investors, but hey, did this turn into a bubble? Eventually, people who got these mortgages, people who got these houses on loans would not be able to pay them. And when people could not pay them by the end of 2007, not good. All these investors who invested their whole life savings into these mortgages, well, they got screwed over. The economy tanked, and the Federal Reserve had to act extremely quickly. So what they did was lower interest rates yet again to spur some economic growth. It's understandable that why John B. Taylor would say, hey, if you increase interest rates earlier to control for these housing prices, maybe we wouldn't be in this situation where we would have to lower interest rates even lower. But this is not the job of the Federal Reserve. Recall from the earlier parts of this video, the Federal Reserve needs to achieve non-inflationary growth. And what it has to do is maximize employment and control prices. Nothing in the mandate by Congress said that it had to burst bubbles. It would actually be much worse in the long run if the Federal Reserve constantly hiked interest rates at any signs of a bubble. It would just stifle economic growth. Unemployment would be pretty high. So what the Federal does really well is clean up. So it used something really unusual, actually, quantitative easing. It bought back the toxic assets, the bad mortgages that the investors invested in, to provide more liquidity in the financial sector and save some banks. A lot of people don't accredit the Federal Reserve for doing this, but it really preserved financial capitalism as we know it. I wasn't even old enough around 2007 to understand this, but people were really worried at that time that the whole system was about to collapse. And the Federal Reserve stepped in to fix this problem by lowering interest rates to spur some economic growth, to lower the unemployment rate, right? And also get rid of these bad mortgages. But it's not really in academia that the Federal Reserve gets a lot of hate. It's really within a lot of the politicians. And the main one I'm going to talk about is the ones that come from more conservative kind of politicians. Libertarians, conservatives. So the most infamous one is the Federal Reserve prints far too much money. You ever realize that cars nowadays are so much more expensive than they were back then? A Corvette C2 was around, what, $3,500? $3,500. What can $3,500 get you now? A used Miata? I mean, I love Miatas, but that's no Corvette C2. Hardworking Americans would look at the Federal Reserve, a banking institution, like, hey, you printed far too much money. Now our hard-earned American dollars are worth much less now than what they did way back then. Are you printing too much money? Are you giving far too much money to your chartered banks? Oh, this is just, I guess, to put it this way, ignorance. The Federal Reserve no longer cares about the money supply. It doesn't increase the supply of US dollars in the economy all that much. Most central banks no longer use this as a tool. Remember, the FOMC, the Fed, changes interest rates, and they do so by buying and selling securities to change the amount of reserves in commercial banks. Right? This has nothing to do with increasing the supply of money. They don't ask US Mint to print more coins or something. That's not what they do. The changes in money supply no longer matter to the Federal Reserve. Since the 1980s, what they do is increase the monetary base. The monetary base is currency in circulation, US dollars in your pocket, and the money in reserves, either in the Federal Reserve Bank or in the chartered banks. Now, this technically is not money that as we know it at least. This is money in reserves. They are not in circulation. So even if the Federal Reserve, let's say, buys or even sells US Treasury securities and increases or decreases reserves, it doesn't really change the currency in circulation. This inflation that we perceive or see in the real world is due to the fact that the US uses fiat money. And fiat money is a lot better than money that's backed by gold, and infinitely better than money that is actually gold. We no longer use the gold standard. And if you're more interested in this topic, the next video I'm doing is going to be on why no one uses gold as currency anymore. Now, the last complaint of the Federal Reserve is that the Fed may be collaborating with moneyed interests, the extremely wealthy bankers or other capitalists, etc. This one, I think personally, is the most relatable. There is always a possibility for anything, and it could be possible that behind closed doors there may be something fishy going on between the Fed and the financial institutions, right? The chartered banks. However, I think the possibility is quite low. The Fed is focused primarily on changing interest rates, and lowering them or increasing them doesn't dramatically improve the, I guess, profitability of the banks all that much. Really, if you look on their website, they audit banks. They make sure that they fulfill their reserve requirements. And those banks that don't do their job, they get penalized heavily financially. But they are not the judge and jury. They are simply the custodian of the economy. People also say the Fed should be audited. I'm not even going to debate that one because the Fed gets audited a lot, both by private and public institutions. Check their websites. I'm tired of seeing audit the Fed on Facebook when they clearly do. People also love complaining about how the Federal Reserve is not really part of or under the U.S. government jurisdiction. Congress doesn't completely oversee, the president doesn't oversee, Supreme, But this is a good thing. Thank God politics are not within the Federal Reserve, because what would presidents do? Lower interest rates right before the next election so they can get reelected again, because then the economy will get kind of an artificial growth spurt because people can buy commodities. So there it is. A simple overview of the Federal Reserve System. If you're just as passionate about economics as I am, you can check out my other videos that I'm going to be putting out very soon. See you then. It's the Commie Bastard, out.